All right, our topic for this week is analyzing financial statements and ratios. If you remember back to week one, we said that finance in the context of sport encompasses a number of different financial concepts. We looked at that umbrella and there were a number of concepts under it. One of those concepts was accounting. So, this process of recording, summarizing, and analyzing financial transactions. We're going to spend this next week identifying key financial statements used by sport organizations, as well as look at how to calculate financial ratios. The information provided as a result of understanding these financial statements can be really helpful for sport organizations and sport managers who are looking to make important financial decisions. So after we cover this unit, you really should be able to, one, be able to identify key information on various financial statements and just identify the statements in general. You will also be able to calculate financial ratios given that data and be able to interpret the results of those calculations and what they might imply about the financial condition of a sport organization. And again, I'll echo a sentiment I stated in week one in that I'm really interested in the applied nature of this topic. So, it's less important to me that you memorize specific formulas, but more important that you're able to implement those formulas and then interpret the information that came out of running those calculations. So, that's a little overview of our topic for this week. And I like to start all of our content lectures with this question of why. Why might this be important to me as a sport practitioner or future sport practitioner? Because I know sometimes these concepts might seem a little abstract and it may be difficult for you to really tie it to your own career path. So I like to start with why and think about why this might be important for us as sport practitioners to be aware of. Well, first and foremost, a lot of sport organizations actually release their financial information to the public or a governing body. Last week we talked about the different sectors in the sport industry, and we noted that organizations that are public, organizations that are considered to be nonprofits, college athletic departments, parks and rec departments, these are all organizations that fall either in that public sector or nonprofit sector of the sport industry. And as a byproduct of that, many of these companies have to share their financial information. So with that said, you could be employed by one of these organizations that, is held accountable by the public for their financials. So it'd be important for you to be able to, one, be able to identify that information, but also to have an understanding of what it means for your company, and if you ever have to speak on that information, that you'd be able to do that. Okay, so what does financial ratio analysis specifically tell us about a company? Well, we're going to talk more broadly about financial statements, and then we'll spend the second half of our series today talking specifically about this concept of financial ratio analysis. But broadly speaking, there are several things that we can find out about a company through financial ratio analysis. One, we can just kind of gauge how well a company is operating in a current time period, right? As you'll see when we start to look at these financial statements, generally they're for a year's time, so they're an annual financial statement. So we can kind of gauge how a company is doing financially during that 1 year period of time. We can also look at financial ratio analysis as a way for us to compare past to present. So we can look back at past financial statements and conduct financial ratio analysis to see whether or not a sport organization is growing, or maybe they've had some losses or changes in recent years. So that's valuable. We can also compare performance to industry standards, and this is going to be something that I bring up a lot in our conversation this week. Oftentimes, financial ratio analysis is used as a comparative tool, right? We can use it to gauge how company A is doing compared to company B or C. And being able to compare it to industry standards is helpful not just for the company doing the comparisons, but also it's helpful for maybe an objective outsider who's interested in investing to be able to compare these numbers. Finally, Financial ratio analysis allows us to study the efficiency of operations for a sport organization. So it's not just a bunch of numbers in a bunch of financial statements. We can actually calculate financial ratios that will tell us whether or not a company is actually efficient in its operations, which could be really helpful to us as a company that's looking to maybe partner with another sport organization or potentially as an investor. Okay, so one good example I like to use when we're talking about financial ratio analysis and why it might be useful, I always like to go back to the infamous Denver Broncos partnership with the company Sports Authority. If you're not familiar with this, the Broncos signed a multi-year naming rights deal with Sports Authority in 2011. And this was kind of a record deal at the time, multiple millions of dollars in a long-term contract. Well, just 5 years later, after this deal is signed, Sports Authority files for Chapter 11 bankruptcy. So the company folds, and obviously there's a direct impact here on the Broncos, right? Because they've got this long-term contract with this company and they're expecting a certain payment each year from this company. So I use this example in the context of our financial ratio and statement discussion because I think it's evidence of why it might be important for a sport organization to do a little bit of homework into the companies that it's going to partner with, whether it's an investment opportunity or in this case it was a marketing partnership, right? There are dozens of examples where your sport organization might look to connect with an outside organization, and your financial health as an organization might be directly tied to that company. So it is important to take the time, do the homework, maybe assess the financial health of that organization before getting into any kind of long-term relationship. And obviously, had the Broncos maybe taken some time to do that or reassess the financial health of Sports Authority, they might not have signed up for that deal to begin with. Okay, so before we get into the discussion on financial ratios specifically, I do want to talk more broadly about financial statements. So when we talk about financial statements, we're talking about written records that convey business activities and the financial performance of a company. Ultimately, we can use financial statements to kind of check in on the financial health and performance of a company. As I mentioned before, we can do this in real time by looking at the annual report of the most recent year. We can also go back in time and look at past years. We can assess growth over a period of time. So there's a ton that we can do with the financial statements that a company might keep on record. A couple things to note here before we identify the three basic types of financial statements. The first is that context matters when we're looking at financial ratios, right? So we're going to be looking at a ton of financial statements here over the next week, and you're going to be calculating financial ratios using that data. And it's always important to remember that context matters, right? And that we always want to not just look at these things in a silo. So we don't just want to look at the calculations of a single company, but we also want to be able to compare that data to maybe competitors, other companies in that industry, so that we can get a full holistic picture of what those mean. So context matters. Also, keep in mind in context of financial statements, every company has kind of its own way of putting the data out there. So while there's these basic frameworks and types of financial statements that we'll see, sometimes one company might do things a little bit different than another. So the verbiage that you see might look a little different in some cases. You'll see that I point that out in the Callaway golf practice case that you're going to be looking at later. There are a couple of other things to keep in mind in terms of how financial statements are organized. Most companies will keep kind of the same framework, but you always want to keep an eye out for things moving around. Okay, so our three basic types of financial statements are listed here. We've got balance sheet, income statement, and statement of cash flows. We're going to look at all three of these here today, and then you're going to get some real world practice with these through our practice case with Callaway Golf today and also the practice case that you're going to do as an action item this week. So you're going to get to know these financial statements pretty well over the course of the next week. But before you do that, I do want to give you kind of an overview of what you're actually looking at when you look at these statements. Okay, so balance sheet is the first financial statement we're going to look at. As you can see here on the slide, balance sheets are generally just a snapshot or a picture of the financial condition of an organization at a specific point in time. I always liken balance sheets to Insta stories for all my tech savvy students out there. So I say this because balance sheet is really going to provide you with the most up-to-date information about a sport organization in real time, right? It's going to give you kind of the highlights of what you're looking for in terms of the overall financial health of that organization. So in a balance sheet, you're going to find 3 different sections, okay? Assets, liabilities, and owner's equity. Assets are what the company owns, right? So you'll see things like cash, inventory, and then other sort of assets that they might have acquired. Maybe some companies have acquired real estate or land. They would include that in the assets section. Liabilities, on the other hand, is the company's financial obligations. So here we're talking about the debt the company owes to others. And then that last section there at the bottom is going to be owner's equity. So basically, what's left over after you account for those liabilities is going to be the owner's equity. This is also going to provide you a window into the shareholders' equity, so investors' equity, and you'll learn more about this section when we start looking at the profitability ratios. What's liquidity got to do with it? A great question. I'm sure you've always wanted to know the answer to. We have to be able to identify this concept of liquidity when we're looking at a balance sheet. So liquidity is the degree to which an asset can be quickly sold and turned into cash. So you're going to find that when you're looking at a balance sheet, you're going to see things called current assets, and then you're going to see long-term assets, and the same is true for liabilities. Basically, if you're looking at a balance sheet, the most liquid items are going to be listed first, and then it's going to go from there down the list or down the line. So the items that can be turned to cash in the quickest way are going to be listed first, and then the ones that are a little bit harder to translate into cash will be lower down. And this will make more sense when we get into our first set of ratios. But keep in mind that that's what this concept of liquidity refers to. So basically, the income statement is a statement of financial performance, right? It's looking at revenues, expenses, profits, and losses. And basically, we can tell pretty quickly whether or not a company is making money through its income statement. So obviously, the focus here is on that money coming into a company. One thing to note as we think about an income statement and a financial statement that's reporting income is how that money gets reported within the organization. And for those of you who've taken accounting classes, probably aware of these terms. But basically, there are 2 different ways of accounting for incoming cash for an organization. You can do so using cash basis or accrual basis, okay? So cash basis, as you can see, is real-time accounting, meaning that the accounting person recognizes a transaction when the money is actually received or paid out. So if a college athletic department gets a check for a sponsorship and they record it once they get the check, they're doing cash basis accounting. Accrual basis accounting is a little bit different. Accrual basis accounting actually accounts for incoming and outgoing money when the money is earned or billed. So as opposed to cash basis where you wait till you actually have your hands on the money to account for it, in accrual basis, you account for the money the moment you send out a notice or a bill for that money. So that's the big difference between cash basis and accrual basis. It's important to note that, depending on the type of accounting used, that might actually have an impact on what is going into that income statement and the type of information that you have in terms of when it's updated. Okay, let's look at a practice case here just to put this into practice. We've got a college athletic department that has reached an agreement with a local bank for a 1-year sponsorship. The value of that sponsorship is $15,000. The invoice was mailed to the bank's finance office on June 1st, 2017, but the payment didn't come in until August 15th, 2017. So if the athletic department used cash basis accounting, when will they record that payment? And then also want you to do the same for if they use accrual basis. So feel free, if you want to try this one out on your own, go ahead and pause the slideshow, give it a try, and then you can come back for the answer. Okay, so if the athletic department is using cash basis accounting, they will record this check of $15,000 on August 15th, right? Because if they're using cash basis, they're using real-time accounting, which means they're not going to account for that money until they actually have the check in hand. If they're using accrual basis, then they're going to account for it on June 1st, 2017, the day that they mail the check. Okay, so what might be some issues with doing, either of these approaches? Keep in mind that either of these options is okay, and depending on the organization, they determine what is best for their operations. Keep in mind that there are some issues if you use accrual basis accounting in terms of balancing records, right? So it's fine to use accrual basis, but you'll want to make sure that you're maintaining balanced records to ensure that you're accounting for all that money coming in. Also, keep in mind that sometimes fiscal years end in the middle of the year. So let's say if this college athletic department's fiscal year ends July 1st, then the type of accounting they use might play a role in whether or not that money actually gets recorded in the current fiscal year. So these are just some things to be thinking about when it comes to accounting. Again, this is a little bit of a sidestep from our conversation here, but it's important in the context of what ends up on that income statement. So statement of cash flows is our last financial statement that we're going to look at. This is a financial statement that tracks the cash moving out or flowing out of an organization. So we said income statement was basically a statement to look at financial performance, and a statement of cash flows is going to look more specifically at how that cash is actually being spent by the organization. So you can see it's broken down by 3 different sections here: operations, investing, and financing. So operations just refers to the organization's cash flows from normal business operations. So basically cash flowing in from the sale of products or services, cash flowing out by paying employees' salaries, that kind of thing. Investing is going to cover activities like buying and selling assets, maybe purchasing land or property, or other investments the company might be making. And then financing, that last section, is going to refer to the company's debt and equity financing, such as, let's say, the sale of a stock or repaying a loan. Okay, so that is a very brief overview of financial statements. And the second piece of our unit this week is actual financial ratio analysis. So taking those financial statements that we've identified and applying a set of accounting procedures so that we can evaluate the financial condition of a company. So part 2 of our lecture series this week is going to basically be just a real-time application of each of the financial ratios. So rather than me sitting here and just listing each formula and explaining to you what they mean in an abstract fashion, I'm going to share some mini video lectures that are going to show you how we actually apply each of these ratios to real-time financial statements. So you're going to see all of these, except for this last one here, market value ratios. I've created videos for liquidity ratios, asset management ratios, leverage ratios, and profitability ratios. In the interest of time, we're just going to focus on those 4 sets of financial ratio analysis. Still important for you to do the textbook reading on market value ratios, but it's just not as relevant to what we're looking at in this class. So we're going to focus on these 4. And the way that I'm going to do it is actually using a real company's financial statements. So I've selected the financial statements for Callaway Golf Company And what I've done is I've recorded videos on each set of those financial ratios. So you get to see me actually apply each ratio to those financial statements or using those financial statements. So I'm going to leave it up to you with how you ingest that information. It's totally up to you. If you want to just watch those videos and kind of take it in as I walk through them, you can. And obviously you can always go back to them later if you're having trouble understanding. I've also created this financial ratio guide, kind of like a study guide that I'm going to throw in your module for this week. So what I would recommend if you're someone who needs to kind of write things down as you're learning, I would print this out. And then as you see me go over each of these ratios in the videos for Callaway Golf, write down and fill out this form in this guide. And not only is that going to help you sort of take in the information, it's something that you can use later down the road when you're going to have to apply these again. And after you finish completing or reviewing the Callaway Golf videos, then one of your action items for this week is to actually complete some financial ratio analysis on your own for another company. Okay, so you are going to have to do some of this on your own, so I highly recommend watching those Callaway videos first just so that you can see how it's done in real time. Your book, your textbook reading for this week also does a good job of going over each of the financial ratios and the formulas. So that's my advice to you in kind of approaching this. Don't worry if you don't feel super strong about each of these financial ratios by the time we meet in class next week. We are going to spend, the bulk of class going over them, debriefing, and then we'll try out probably some additional practice cases in small groups. So you're going to get a lot of practice doing this. Okay, last thing I want to mention here is just a quick wrap up. Obviously what we learned in part 1 of our lecture series today is that financial statements give us a ton of great information about a company's financial health. But really, if we want to do something with that information, we need to do some analysis. So that's where the financial ratios come in, and where part 2 of the videos that you're going to go look at after this are really going to help you learn what that information might be, and then what we can do with it and how it might help us assess the financial health of a company. Keep in mind as you're watching those financial ratio videos and as you're doing your own practice cases that any result that comes from a financial ratio calculation should be taken within the context of the industry or company norms. And that, again, we don't just want to look at these things in a silo, but we want to make sure that we're able to make comparisons in order to gauge whether or not something is good or bad. All right, our goal for our class meeting next week is that, by the end, I think by the time that we finish our discussion, if provided a financial statement of a sport organization, I want you to be able to feel comfortable calculating financial ratios and then drawing conclusions based on those results. So that's really our goal this week in terms of outcomes. It is going to be a lot of math, so hang in there. And those videos will stay up, so if you need to come back to them later, you can. If you have questions, let me know. Otherwise, I'll see you in class. Thanks.